AI Media says its annual recurring revenue is scaling rapidly with an 80% increase to $30 million in the first half. The company also lifting its ARR growth guidance for full year 26. Revenue, though, in the half declining 6% to just under $30 million. The company has also withdrawn its full year 29 earnings and revenue targets, saying the AI market is evolving too fast to make these assumptions. Total revenue for the half down 6% on the prior period, with AI Media saying this reflects a business model transformation with the launch of new AI encoders. Let's get more now with AI Media CEO Tony Abrahams, who joins me now. Not a great day for shareholders. Talk us through the numbers in your words.
Well, I think you summarised it really well, right? I mean, we came out with our half-year results and people see revenue down 6%, they see negative EBITDA, and they see you've withdrawn your FY29 targets. But actually, if you double-click on all three of those things, they actually tell a much different story. If we start with revenue, what we saw was annual recurring revenue growing at 80%. Now, we had forecast a full year annual recurring revenue growth of 35% at the full year. So we've now upgraded that full year guidance to 50%. And it's really that annual recurring revenue that was always going to form the basis of those FY29 targets, that while we've now formally withdrawn those targets because they're a single point in time forecast, they were never board approved, right? They were always framed as a CEO aspirational target, and they were just a point in time forecast in FY29. Instead, what we're actually saying, well, we've got a lot more precision now about how we're going to effectively deliver that same unit economics, how we're actually going to deliver that same level of growth. Because the FY29 targets were 150 million in revenue and 60 million in EBITDA. And at the time, we didn't have a business model that was going to deliver that. What we've now shown and revealed is that underlying business model, right? That engine of the annual recurring revenue. But we've done that by shutting down our legacy services business, which had very high revenue and very low contribution margin. So what you saw in that revenue decline was two things happening, both of which were intentional and strategic, and both of which will help underpin those long-term futures. One was we went fully AI native. So we shut down entirely that legacy services business, which is now at zero. So that saw a 33% decline for the revenue half on half. And then we also saw a decline of 40% on hardware. But we did that because we're launching a brand new series of AI native encoders next month. And we're launching them on a hardware as a service model. So people, rather than having to come up with $15,000 in CapEx, will be paying $500 or $600 a month for us for these brand new encoders that include GPUs in the device. And remember, we're all about an AI infrastructure layer that sits at the broadcast end. So effectively, we are orchestrating between a video signal that we want to come in with really low latency. So our device has to be with a cable that's less than 30 centimeters long. That's how close we have to be to the broadcast signal. And then we have to have the media asset management layer that actually talks to the scheduling systems and the playout systems, so that we know what are the topics.
So, I mean, this house model, as you say, the second half, what expected revenue cash flow will that bring if you are materially upgrading that ARR target?
Yeah, so look, we launched the models next month in Las Vegas at the NAB show. There are 8,000 legacy encoders that are out there in the field at the moment. We've set a target in the first year to refresh 1,500 of those onto the new HAS model, as well as continuing new sales. So it'll be interesting to see where we get on that. But initial interest from customers has been this is going to help them speed up a refresh cycle because they're not going to have to come up with millions of dollars of CapEx. And also they're very happy for us to take the risk on our own products in the same way that they're now expecting from other vendors.
Given how fast AI is moving, as you point out, potentially not too much of a surprise that you withdraw that forward-looking guidance, but what do you see as the biggest risks over the next, say, 12 to 24 months, given what we're seeing in AI competition, regulation, and other macro pressures?
Yeah, look, I mean, we didn't really withdraw the forecast because there's a whole lot of AI in the, uncertainty around AI. It's just there's a better way for us to tell the story to get to that same unit economics. That's board approved, that's call it period by period rather than some point in the future. So, and we're actually going to report on annual recurring revenue, ARR margin, which is currently 84%, ARR growth, which is currently 80%, and expanding EBITDA margins. Now, the point around EBITDA that's really important is we expense all our R&D and product development. If we didn't, we would add back $2.6 million in the half for that. So that would take us from a minus 400,000 to a plus 2.2 million in this, right? But what all the AI is doing for us is helping our business because we fundamentally own the piece of hardware that sits closest to the broadcast stream. And when people come up with more and better AI applications, we just have to increase the power of that device, and that's going to get a response faster and more accurately.
Still, though, I want to know what your biggest concerns are over the next 12 months, particularly given what we've seen with the disruption with what they're calling the SaaS apocalypse as well.
Yeah, well, look, for us, it's actually about focus, right? There's you talk about a product like Lexi Voice, which is about real-time AI-powered translation, and you realize it's actually a very different product if you're delivering this into a baseball stadium, if you're delivering it for a large pharmaceutical company, into 4 languages across all of their internal meetings, or if you're doing it for broadcast. Now, it's not yet ready for broadcast. The sentiment, right, isn't quite there, but it is ready for those corporate settings. So what we need to do is make sure that we're investing in the areas where there's product market fit right now. We're investing in the go-to-market resources, but we're also investing in the product and support resources to ensure that those initial customers on these brand new products that we've invested in will be great index customers that will help us get others along the way, and we can't do everything at once. So the biggest risk is actually spreading the peanut butter too thinly over too many pieces of bread.
You've added several new international markets. What are the growth opportunities there by region? What's the next step?
Yeah, so the way we kind of categorize things is in a 9-square matrix where we've got broadcast, government and enterprise as the 3 main markets. Traditionally, we've been in broadcast. And then we look at things in the 3 regions of Americas, EMEA and APAC. And traditionally we've been in the Americas. 80% of our business is actually still out of North America. And what we're doing is we're trying to expand the opportunities that we see into all of the other 9 squares. And so we've done pretty well in government in the last period. So we increased the total share of government revenue from 5% to 7%, and that's with some new SOC 2 and ISO accreditation capabilities. And the other thing that we've built in native is data sovereignty, right? So our equipment's 100% made in the USA in a factory in Farmingdale, Long Island. But the data is catered to whatever the individual customer needs. So if they need the data not to leave the EU, it doesn't leave the EU. If they need it not to leave their corporate firewall, it doesn't leave their corporate firewall. And this has allowed the US Department of Defense to really approve a lot of these devices for the first time. And so we're expecting with that, our Lexi Local series will continue to roll out. That's on the government side. And then on the enterprise side, it's really the Fortune 500 companies, right? It's those Fortune 500 companies that have got diverse international workforces who speak different languages, where precision is really important, where a transcript and quality assurance of what was being said was really important. And you need it in French, English, German, and Spanish simultaneously. Right, and that's a workflow for Lexi Voice that we're deploying with those new encoders.
When you touch there on the EU, I mean the Accessibility Act, how is that affecting demand for captioning and transitioning services? How are you sort of positioned there to capitalise on that?
Yeah, and again, this goes to that multi-year timing, right? Because this happened in June of 2025. So the regulations came in June of 2025, so 8 months ago. And we needed to be there because they didn't do any captioning before that. Now in the US, they've been doing captioning since 1989. So it's taken the Europeans 35 years to even catch up. And so what the initial legislation was, well, you've got to start captioning. So the first thing that we sold in were encoders, right? But then each European country's got a different language and a different broadcast standard and different local manufacturer, just like all the plugs are slightly different, all the voltages are slightly different, all the broadcast standards are slightly different. You might have a character that's particularly unique in Albanian or Cyrillic. And so we've got to make all those changes, and that improves the overall application of the product. But say, for example, Greek. We can't do Greek yet. You would think, oh, well, that should be easy. Well, it turns out it's not. We can do Mongolian, but we can't do Greek. So we've got a team working on Greek. So we are seeing a lot of demand. It's slow because the legislation, say, for example, in the US is 24/7. The legislation in a lot of European countries is just 4 hours a day. So we'll see the Lexi take off. But really where we're seeing the big opportunities is in the US, and it's still in that opportunity set where we're still 1/3 of the total captioning in the US is being done by our competitors, and we want to grab that share as well. And that's probably the biggest lift because it's our biggest market.
And when does all this turn things around for shareholders, given the big slide you've seen, particularly even since late last year?
Look, I think, it takes a while for new information to be processed. Like, we've unpacked quite a lot today, which a lot of shareholders wouldn't necessarily have the time to do on the day of the busiest results drop. But, hopefully just when people can see the annual recurring revenue continue to grow, right, north of 50% at a margin north of 80%, and we see, in terms of unit economics, 80 cents in the dollar flowing through to shareholders, then those who are patient, I think, will be rewarded.